much for coming to our tax info session. We are doing this in person as well as we are streaming live to Instagram and Facebook. So hello to all virtual viewers. We're going to be going through some tax prep with you guys, and then we're going to be opening the floor up for questions. So if you guys do have questions while we're going through things, you can either write them down or it makes sense to kind of put them in as I'm talking. That's great, but we'll go through everything at the end for you guys. So first of all, thank you for choosing to make the investment in yourself and or your business by being part of our tax info session today. I'm the owner of Danielle's SOS Bookkeeping. We're an accounting office that also offers personal taxation services. For those of you that don't know about us or have never used our services before, which is most of you in the room, obviously there's some new and some returning faces, which is great. I always do one of these tax printouts. What this is supposed to do is give you some very important pointers to get you prepared for tax season, as well as, if there's more questions, kind of inspire those questions based on, I would love to say that this is 100% of everything you're going to need to know about taxes, but unfortunately that's just not the way it goes. So we do try and pick the most important points, including going through some deadlines that you guys are going to need to know about, as well as some basics about tax credits, who can claim what, and when you can claim different things. So let's talk about who we are a little bit more. So who am I? My name is Danielle. Like I said, I'm the owner of the business, and I got this business started in 2014. I started the business from my house because I was a stay-at-home mom, and I thought, I love doing taxes, that's my education background, and it'd be fun to run my own business. Since then, we have graduated to an office, multiple staff, and we just bought our commercial building a couple of months ago, so we are currently moving, or in the process of moving, which you will note at the top of your sheet. So currently, we are operating our main office on 51st Avenue, which is Roper Road, that direction, about 10 minutes. We will be there until the end of February. We do have a satellite office opening at our new location February 1st, which is the address on the second line. It says satellite office, okay? I will have a tax preparer as well as just some bookkeeping staff move over to that location, so we will be able to offer personal taxes for anybody that's ready to go in the month of February before the e-file desk opens. Once we get everything permanently moved, we should be in the new office the first week of March. If there are any deadlines or any adjustments we're going to need to make, they will be posted on our website. So we will be officially Northside, Beverly area going forward. All right, so let's talk about why we're here. I always love asking this question because it makes me giggle. Who here has ever felt personally victimized by tax season? Felt like we don't know something, felt like we have questions, felt like the tax man is kind of working against us? Great. It's the truth, okay? When I start these tax talk, I talk about the fact that, let's face it, CRA doesn't want you to know everything about filing taxes because they would lose a hell of a lot of money in tax season if everybody was properly educated. You can go to tax filing services, you can do it yourself. All I'm recommending to you is that you get educated, okay? There's lots and lots of information online. You can browse through the CRA site. Personally makes me want to throw up, try to navigate it and figure out what they're actually talking about, and then also relate it to practical terms on how it relates to you. That's my job, okay? So let's talk about the most important deadlines that you guys need to know about. First of all, T4 season, right? If we work for an employer, we are waiting for that lovely, beautiful T4. People start to get antsy. In our office, we're actually starting to put together our T4s for our clients, and everybody's calling us saying, where's my T4? Where's my T4? Well, it turns out your employer does not have to have your T4 to you until February 28th, which means that if you are currently sitting at right now, at any point between now and the 28th, you are not actually entitled legally to your T4 until that point. So give your employers a break. It's an incredibly busy time of year, and it still leaves you lots of time to file your taxes, even if they stick it in the mail on February 28th, which hopefully they don't. But if that's the worst case scenario, that's how it works. The other thing that we're worried about right now is RRSP contribution time. Everybody's scrambling at the end of the year to get those last minute RSP contributions in that are going to affect this year's taxes and apply to last year. Your deadline for doing that is March 1st. I don't recommend waiting until March 1st to do it, but that is the absolute last possible deadline you can do it. If you are one of those people that files on March 1st or contributes on March 1st, you will probably be waiting till the middle of April to get your tax slips. So either write down the amount, be proactive in that regard, because you can file your taxes without the official slip as long as you know dollar for dollar what the actual contribution made was. Otherwise, let's pass on to the next deadline. Your actual investment, contribution slips, things like that. The institutions and the banks legally legally have until the end of March to issue those statements. Reason why is because the RRSP deadline is March 1st. So they physically have to have the time to put together those slips for you and get them out to you so you can file your taxes. Now, what does that mean? Last year, we had the final RRSP posting from the institution to CRA April 27th, which sucked. For anybody that was waiting for them to be uploaded and didn't want to call their institution or bank, we were left in a little bit of a mess at the end of tax season because we're all scrambling to wait for it, get to the next important deadline, which is April 30th, which is the last possible point for you to file your taxes for last year without any interest or penalties. Okay? We can file taxes all year, every day, all day long. But as soon as we pass the April 30th deadline, you're now eligible for those lovely interest and penalties, which the government loves giving to us. So the second, the deadline underneath that is for sole proprietorships. Okay, and we'll hear a lot of people say June 15th. H&R Block and all the other wonderful, lovely companies will be on the radio saying, "Don't worry, you have until June 15th to file your taxes if you're a small business owner." This is crap. Okay, June 15th only applies to a late filing deadline, which is just one more lovely interest and penalty deadline that CRA uses. If you owe tax and you are a sole proprietorship and you file by June 15th, they still calculate your interest and penalties back to April 30th. So April 30th is your deadline. Keep that in mind. Now, if you get a refund and you're not worried about paying taxes, you can file whenever. April 30th actually means nothing to you. You can file in May, June, July, August, whatever the hell you want, pending that you're okay waiting for your tax refund for a little bit longer, but you can file any point during the year without penalty or interest. That's your own money coming back to you. CRA would quite frankly like it if you never filed taxes or waited a hell of a long time to do it because they have to give you money. But when we owe tax or we're unsure if we're going to owe tax, we want to make sure we're adhering to the April 30th deadline. All right, so we're going to dig into everything. Oh, last point on deadlines that you guys need to know is that officially the e-file desk this year, so our ability to actually transmit taxes does not happen until about the 25th of February. Now, that being said, we can do pre-appointments starting February 1st, which means we can sit down if you're like, I have one T4, that's all I got, I'm ready to go. We can prepare your tax return, get it all ready to go, and then add it to an e-file wait list. As soon as the e-file desk opens, we go ahead and we send all of those in, and it usually takes about 2 to 3 weeks for them to process. Our office does not offer instant tax back. Okay? People, ask on a regular basis, and they ask me, "Hey, Danielle, why don't you offer this service?" Well, unfortunately, I don't believe that I need to be paid anything else other than your fee, which you're paying me to prepare your taxes. And I'm legally allowed to ask for up to 30% of your refund in fees to pay the government to offer that service. H&R Block, Liberty Tax, some of those competitors, they will offer you that for the instant satisfaction of your money. I don't believe that 2 to 3 weeks is that obscene of a deadline to wait for our tax refund to get 100% of our money. So, as a personal preference, it's just one thing we do not offer, and I will, potentially never offer it just based on that. Okay? All right, let's talk about some new and improved benefits and credits. So I think these 4 is the most important. These are as of last year. Now, the reason why I spend some time on things that started last year is because regularly we get people filing 2 years of taxes, 3 years of taxes, and there are changes that are in effect, and these are going to be long-term carrying forward tax credits that shouldn't go away anytime soon. That being said, I will find out next year if I am wrong on that. But we do watch it from year to year, and we pay attention so that we can let you guys know if there's any significant changes. Last year, the significant changes happened that we don't see happening again, which was the split up of the tax brackets. So now there are 5 tax brackets, which is good and bad. What the government was aiming to do was give more people the ability to pay less tax. Unfortunately, in my opinion, all they did was give a little bit more tax break to the people making a lot of money, because they spaced out the tax brackets and increased the threshold for anybody making income over 120, 200,000, or 300,000. So the average person working in the first 2 bottom tax brackets, which is where probably 70 or 80% of Canadians sit, we do have a little bit of flexibility, but unfortunately when we do jump from the first to the second tax bracket now, we have a nice big 5% increase, which means it's very noticeable when our income goes above $42,000, which is the threshold break from the first tax bracket to the second. Okay, so that's your magical income threshold, and then the next one is about $89,000. So if you are under $90,000, you're paying about 30% tax. If you are above that, you scale anywhere from 30% to 45%. Yes, the government does collect almost 50% of your money, and that is just simply because You make a lot of money, you got to pay a lot of tax, and hopefully you're smart enough to use some of the strategies we're going to talk about in here to leverage your own money and get a bigger tax refund. All right, so home accessibility tax credit. We have a very large number of baby boomers in this province, which means we're getting to, a lot of older clients that are looking for ways to improve their household based on disability purposes. Now, this is not just for the elderly, this is also for people that have kids with disabilities, everywhere across the spectrum, but this tax credit specifically was implemented more for the benefit of baby boomers. So if you yourself have a disability or someone that you know has a disability, in their home they're allowed to install things like ramps, wheelchair access, lifts, special bathroom accessories, things like that, and they can qualify up to $10,000 for those expenses on their tax return. To qualify to write that off, though, you have to have the disability tax credit with CRA. That does not mean you just have to self-proclaim that you have a disability. Unfortunately, CRA will require that you prove that you have the disability tax credit, as well as you want to be 100% diligent on your paperwork and make sure that you're keeping 100% of the receipts, because they will be asked for. It's not a they could be, it's they will be. Okay, there are certain categories on our tax returns that we can pretty much guarantee are going to get eligible for an audit. This is one of them. Unfortunately, we can thank the 5% that screwed for the 95% by cheating the system. So that one's something to keep in mind. For anybody with kids in the audience, we now have, as of last year, an amalgamated Canada tax benefit, which means we have one child tax benefit, one amount of money for our kids. It is slightly more than it was previously because it's been amalgamated, but it's based on family income and the ages of our kids, and it can change from year to year, and it steadily decreases. Why? Because everybody knows kids get less expensive the older they get. No, they don't. I have two myself, and I do believe this is absolutely not true. But in any case, the government has decided to give us a little less money every year as they get older. So it does go downward, and unfortunately, we do feel it quite significantly from year to year, but they do get it, and you do receive it until they're 17, as long as they reside with you. So that's a new change. For anybody in Alberta, this is a big hitter, is Northern Living Allowance. Okay, so for all of our wonderful Albertans that work out of town, we do have a very large population, like I said. So if you work in places like Fort McMurray, Prince George, if you work like 100 different places you can work, but those are my top two because that's all I can think of right now. You can qualify for getting a little bit of extra tax deduction for just simply living up north. Okay, so what you need to keep in mind when you are wanting to claim that, or if you know somebody that's looking to claim that, you need to have letters from your employers that validate that you are in fact up there for a constant 6 months. You can't go up there for a weekend and come back. You can't go up there for 2 weeks and come back. You have to physically live up north for 6 months. Okay, what you need to, like I said, a letter from your employer that shows the contract period. You need an actual physical job contract if you're going to be up there for an extended period of time, as well as or including rent documents or home bills that show that you have an address up there. Again, this is one of those predisposed higher rate for an audit categories. If you are looking to claim it, make sure that you do yourself a favor and get the necessary paperwork together, because it will be asked for. Okay. Things like this one, I'm pointing out things that are slightly higher eligibility for an audit, may not be right off the bat. So you will file your taxes, you will be 100% perfect, no questions asked, and 3 months later, the tax man will knock on your door, send you a letter that says, please prove what you included on your tax return. Okay? It does not mean that you've done anything wrong. Okay? Audits are not scary, audits are a giant pain in the butt, but they're not scary. And all they're doing is just asking you to prove that you actually do qualify for the things that you're claiming, which in my opinion as a tax preparer is perfectly fair. I think audits have received a very negative stigma over the last couple of years because people want something to complain about. And quite frankly, it's just part of life. The government has the right to ask you to prove what you're claiming on your tax return. So let's do a little less griping about audits and just get ourselves prepared with everything we need beforehand so we don't have to scramble. Last one on our new and improved benefit schedule is teachers. You now have $1,000 as a teacher to submit your own expenses to the government. If you have stuff that's reimbursed by the school board, you can't write that off. But if you are a teacher that has to go or chooses to go over and beyond and includes more material and things like that, you can claim up to $1,000 worth of those supplies. But this one is a tax credit. So same as the other ones, is that it is only going to apply 15% of that total, which means you technically only actually get $150 worth of value, lowering against your actual taxes owing. So it's really great, and it's really not that great all at the same time. But If it means a couple more dollars in your in your pocket from your tax refund, by all means, claim the expenses. They're there for you to be able to take advantage of. Alright, so first of all, I'm not going to go through absolutely every point on this worksheet. Okay, there's lots of information here that I could talk for hours on. We're going to try and keep this to an hour worth of talking so we can get to your guys' questions. And if there's more information that's not included on here, obviously, selfish plug, there is an email address on the top of the worksheet. If you would like to get a hold of us and get a little bit more information, please do that. We are more than happy to help. We don't nickel and dime clients for things. If you simply want another copy of this, if you need a little bit more information, you want to know what that tax form is that you need, just shoot us an email and we're very happy to help. Okay? Alright, so I'm going to kind of skip over legal fees during separation and divorce. Basically, rule of thumb is that if you're going through a divorce right now and you are the applicant, which means you are the lower income or you are the person that is going to be receiving spousal support or child support, you can claim some of your legal bills. Now, again, this one is one of those that I really caution you to have 100% of your paperwork in place properly because, again, it does get audited. Okay. The second point, alimony and maintenance. Spousal support is considered taxable income. Okay? So if you are on the receiving side of spousal support, you do have to claim it as taxable income. Child support, not taxable income. And the rule of thumb is that the payer and the receiver do not claim it on their tax return either way. You can put it on your tax return, but it basically just filters into an exempt category, which puts the number on your tax return, but you get no benefit for it. So child support, pretty much off the table. Let's get down to the single most important change that they made last year. You have to report the sale of your primary residence now. Okay? Alberta is a wonderful booming economy, and we've had a lot of people that we want to coin the term house flippers. Okay, which is you buy a house, you renovate it, you sell it. Great. Except that people were or are buying the property, moving into it for 6 months, renovating it, and then selling it, moving on to the next one, claiming it as their primary residence, and getting away from the capital gains of selling that house. Okay, the government for a long time didn't have any measures in place to prevent this. As of last year, they do. So if you sell your primary residence, which you have to have lived in straight for 6 months, if you sell a rental property, if you sell multiple properties, you have to disclose 100% of the information now. Okay? I don't have to go into the conspiracy theory behind how they can find out whether you do not include that information, but if you don't, there's about an $8,000 starting penalty that can be applied to your tax accounts if they find that you did not properly disclose that information. Okay? I don't want to pay $8,000, and I don't think any of you guys do. So if you are in the market of buying and selling houses, just make sure that you're not abusing the primary residence deduction. If it is your primary residence and you simply just upgraded to a new home and you're not a house flipper, that's great. You're not going to pay any capital gains on that primary residence declaration, okay? But they still need to know about it because, again, if you are doing it more than one time a year, you lose your principal residence exemption and you have to pay capital gains on that. Just like if you sell rental properties or any other properties. So that's a big one. Avoid the $8,000 fine and be compliant. It's beneficial. All right. So the next paragraph is a little bit about income slips. This is just some stuff that you guys might want to keep in mind as far as what's considered income, what you might be waiting for, and what you want to keep in mind. The only one on there that is not taxable income is universal child care or Canada tax benefit back payments. So the nature of our business, being Danielle's SOS bookkeeping, is that we do a lot of back taxes, more than people would think. It's not that weird for people to be a couple years behind on their taxes, and when families go and file a couple years behind, they can qualify for back payments on child tax benefits, and I just realized the other one is not lumped in there as well, but you can make a note, is disability. If you get a reassessment based on having the disability tax credit and you get more refund as back pay, those are not taxable income in the year that they're actually received. That's you just getting government money that you should have got all along that was never taxable. So you don't have to worry about that. I've seen people get, $10,000, $15,000, $20,000 back pay from the government and they're going, oh my God, how much do I have to put away for taxes? None. It's completely untaxed income. Okay. Slips will be issued for everything except for obviously your own calculations on rental properties, income and expenses, self-employment, obviously being either conditions of employment, which is the ability to claim some of your expenses working at a regular 9-to-5 job, or complete self-employment if you have yourself a side hustle. Let's talk about big dollar for dollar deductions. So big dollar for dollar deductions. It's been a long Saturday already. What does dollar for dollar mean? So dollar for dollar means that if you have $40,000 worth of income and you contribute $5,000 to your RSPs, your new taxable income is $35,000. Okay, that means you literally take off like 100% of the dollar for dollar value against your taxable income, whether that be from rental, whether that be from self-employment, or whether that be from T4s. Okay, RRSPs are definitely the number one that people talk about on the top of the list. Okay, RRSPs are wonderful tools. They definitely have advantages. We're going to talk a little bit more about that on the next couple of pages, as far as just assessing whether an RRSP contribution for tax purposes is your best bet, or if there are better options for you. And yes, foreshadowing, there are better options for you. But we talk about RRSPs, childcare costs. I'm going to touch on this one because we are doing this in person and we are doing this live, and I do know that I get asked this question quite regularly. Childcare expenses. If you have a kiddo in childcare, whether private, day home, whatever that may be, you are required as the parent to receive the tax slip to claim the amount on your taxes. The individual that is providing the care may not come into the equation and they may not be audited, but you are responsible for providing all the information to prove those numbers. Okay? Things that you need to keep in mind is that actual official daycares will issue you a tax slip. Okay? At the end of the year, if they don't send you one in January or by about the middle of February, I usually just recommend you give them a call and say, hey, this is my right to have this slip. It should have the business name on it, the business address, the name of the child, and how much your fees were. Okay? Now, if you are like a lot of people, the rise of day homes is a big thing. I've used day homes myself. I know lots of clients that use day homes, and this is a heated topic. And this is 100% without question the rule every single time. If you are the day home provider, you are legally required to put your full name, your SIN number, your address, and the same information as the daycare on the slip for your clients. I'm going to say that again. Legally obligated to put your SIN number, full name, name of the child, and the amount that was paid to you in the year for the parent. This is non-contestable. I've had this come up so many times where people have had to go back to their day home providers and argue that they do not have to legally put their information on that slip. Yes, you do. It is your requirement as a business owner in a daycare, in a day home, any other child services type business. Okay? That one, that's actually one of my hills to die on because I don't want to see the people that are trying to claim those costs get screwed because the day home providers are given bad information. Okay? That is your right to ask people for that, and I encourage you to do so. All right, other dollar for dollar reductions. If we have ourselves a business or a rental property and we carry ourselves a loss, which means that we have more expenses than we have income, those loss values are dollar for dollar reductions off our taxable income, which is very important. Okay, we're going to talk a little bit more about that later on in the worksheet, but for right now, it is okay to have a loss. It is all right to have a loss. Everybody has a loss from time to time, and it does directly reduce the amount of tax you pay in the rest of your employment income. Employment expenses, we touched on a little bit before. So employment expenses come into play if you are a contractor that's working a 9-to-5 job and you're required to travel, have a home office, do advertising and promotion. This is going to apply to people like real estate agents. You have to buy advertising, promotional gifts for your clients. You have to do your own advertising, things like that. You get to write those costs off. Those are your expenses. Okay, but in order to claim them, you do need a form called the T-2200, which is a conditions of employment, which means you do have to go to your supervisor or the person that issues your T4 and get them to authorize you to claim your expenses. If you do not have that form, that's a problem, and it will be asked for on a random basis. I'm not going to say that every single one of them gets assessed for a review, but a good number of them do. It's a very easy form. It doesn't cost the employer anything, but it helps you do your due diligence so that you can claim everything that you're allowed to on your taxes. Split pension. I'm going to touch really quickly on income splitting here. Okay, this is a big giant pet peeve in the tax preparer world. In 2016, people started talking about income splitting. That was a buzzword that went around, and it's the bane of our existence because income splitting isn't even remotely close to what they sold it as. Okay, income splitting, when it did exist in 2016, was not, I get to take my income, throw it on my spouse, and both of us pay less tax. That is total crap on a general rule. There are exceptions, being pension split. That is for senior citizens, and if one of you or both of you have pensions, you can run an algorithm that will even out the amount of income on both sides of the tax returns, and you both pay less tax. But if husband makes $100,000, or wife makes $100,000, and and husband or wife makes $20,000, and you go, well, I'm in this big giant tax bracket over here, my wife or my husband is in this tax bracket, we want to be able to split our income and pay less tax, you are unfortunately mistaken. There's no way to do that. Reason why is because you have to pay income tax on the amount of income that you earned. The guy that makes $100,000 versus the guy that makes $20,000, they're in different tax brackets and they're going to pay different amounts of tax. In 2016, when they did introduce income splitting, it was called the family tax credit. Now the family tax credit gave a small scaling tax credit at 15% to the person that had higher income, as long as the lower income earner actually did have earned income, which means you've got dad out in the oil patch and you've got mom as a stay-at-home mom. We do not qualify for that tax credit because mom is not working. Okay? If mom has less than $10,000 worth of income, again, it did not qualify. We do not have this tax credit in place anymore. It was only around for 2016, and I just don't foresee it ever coming back. But everybody needed to argue tooth and nail that income splitting was a thing, and that their accountant and everybody else around them told them they could have, and it's just not what they talked about. Okay? These are the things that I go through with you guys because it's hard for us to sit here and argue what we know to be true against something that you hear a lot of misinformation about, and that is one of those things. There is no real good income splitting unless you are a senior citizen collecting a pension. Okay? Moving expenses. That's my other fun one. Moving expenses. Everybody in Alberta is like, well, I moved from the East Coast to Alberta to work. Don't I get to claim moving expenses? Not unless you had a job offer and a start date and the absolute need to move to facilitate that job contract. If you simply moved from another province to Alberta or anywhere in Canada to move for work, if you just thought there might be a better place to look for work and you did not have a job offer, you do not qualify for moving expenses. This makes people really mad because they sold the market as something that you could write off on your taxes if you move to an area with higher growth. It just doesn't work that way. Okay? If you want to claim moving expenses, you need to keep all the physical receipts. There is a shortcut way to do it, which is claiming a certain amount for the nights that you spent over the kilometers that you drove in a car, but most people rent a moving van and they do it all in one big haul, and that's great. But you need to have your address before you moved, you need to have your address of your new residence, you need to have the job offer to prove that you actually have a start date, you need to list the last date of your previous employment, and basically everything about the move has to be dictated around you actually starting a job. That's just it. There's no exceptions to that rule. With every story under the sun, and I don't care if somebody else gave it to you, they did you a disservice because that's wrong, and it doesn't exist in any other capacity besides moving for an actual contracted job. Make sense? Are we still alive out there?
Oh yeah.
Awesome. All right. So something else really quick is Alberta 2, union dues. If you have union dues or professional fees that you pay, now this is not only people that are part of unions, this is also professional fees for people in the medical industry specifically. If you pay union dues, do yourself a favor and make sure that you have that documentation to prove those and be ready to submit it at any given time. This is one category where CRA can actually do a pre-assessment on you, which sucks, okay? Nothing good about it. What happens is if you file union dues or professional fees, you're part of a category of people that are at a higher chance. The CRA will actually preemptively hold your tax refund until you prove that you have those expenses, okay? I've seen it enough times to know it happens. It's not on a like 80% basis or higher, but there you need to be aware of it because if that happens, you will not receive your tax refund until they are done. You need to submit the receipts. They need to, review them and say, yes, okay, this person does qualify by having paid union or professional fees. Once they're satisfied with that, then they will release your refund. There's not very many categories where this happens. This is unfortunately one of them because there's a lot of people lying about their union dues. Nothing nice about it, nothing more to it than that. It's just people are dishonest and CRA has to find some way to combat it. So that's the way they do it. Okay. Tax credits. The next page we're going to flip over to 15% tax credits. So tax credit. What is a tax credit? A tax credit at 15% means we take the total of all those categories listed there. Okay. The dollar value gets times by 15%. And when you owe taxes, you have an amount for federal and provincial. Okay. This is not the actual dollar value of your refund. This is the amount of tax you owe against what you either paid in an income tax on your tax return, or if you're self-employed, what you will pay in for taxes due. So tax credits go against the tax amount due. Okay, so they widen the gap between the amount of income tax that you've paid, or they just lower the amount of tax you pay, but it's only at 15% of 100% value. Okay, some of the things on this list are very high value, but you're not going to feel them in relation to how big the actual dollar value of the tax credit is, because they do go down to 15%. Things like eligible dependents. If you are a single parent and you take care of a child or multiple children, you can qualify for an eligible dependent, which is an $11,000 tax credit. When I throw out numbers like $11,000, people go, oh my God, that's a huge number. Well, if you take it by 15%, it's actually not that big, and it doesn't equate to that dollar value on your refund. And this is a huge misconception, and I wish they made it a little bit more straightforward when they explained what tax credits are. They are not dollar for dollar increases to your refund. They are just a helpful reduction to the amount of taxes that you're going to pay. Okay? Other big ones are infirm or family caregiver amounts. We're going to talk about what qualifies for family caregiver amount in a second here as well, because this is something that, again, unfortunately, there's a lot of misinformation floating around. Lots of people do qualify for it, but they don't know what the kicker is to determine whether or not they qualify for it or not. Disability amount is another big one. Disability amount, again, if you have a disability, there are 125 possible, actually there's like 260 possible conditions that qualify in part or in whole for the disability tax credit. This is not something that we elect to give ourselves. This is unfortunately something we have to have a doctor validate. We have to have a specific form filled out. We have to submit it to CRA, and we basically wait for CRA to make a judgment on whether they think it's severe enough to qualify for the tax credit. And it can be given for back payments, so previous years if you didn't know you qualified. It can affect you for 1 year singly and say, well, next year you should be better and back to work, so you won't qualify for it again. It could be indefinitely for the rest of your life for someone that has a permanent disability, or it could be renewed on a yearly basis, saying that if you think you're going to qualify for it again, you need to reapply every year. Okay? It can be up to about an $8,900 tax credit. Again, big numbers at 15% though. We bring it down to a realistic scope, and it's awesome and it's helpful, but it's not increasing our actual dollar value of our refund dollar for dollar. For those of us that have kids arts and fitness amounts don't exist anymore. As of 2017, they decided that we don't need to have those expenses anymore. Most plausible explanation is because they amalgamated the child tax benefit, so we get marginally more money on a monthly basis. So let's get rid of a program that, in my opinion, made a lot of sense and helped people get their kids into something active. I don't like the changes that they made, just in case anybody's wondering, but it doesn't exist anymore. So you don't need to worry about keeping your receipts and things like that. If you are filing for back taxes though, you can qualify and use them all the way up to the 2016 tax return, but your 2017 and your 2018 return will not have those expenses included in them. Bus passes. Yes, you can claim your bus passes. You need to keep the actual physical bus pass. Bus pass, okay, that's the kicker. Is they are going to ask you for the actual physical bus pass. The receipt does not qualify, okay? Having the receipt and the bus pass together, much, much better. But as long as we keep that actual bus card, that's what qualifies. Individual little bus ticket, like the little tabs you buy like a week's worth, those don't qualify. You have to buy a monthly bus pass to actually qualify to write off your bus passes. Tuition amounts, again, for all the students, we have a tuition slip that gets issued by the institution that goes on our taxes. It's not taxable income. Those are benefits from the amount of tuition that we paid in. Those are filed on a form called the T2202. They are available from the institution, usually in the back office. I don't think any of the institutions are mailing them anymore. They used to do that, but I think it was a waste of paper, so now they put it in your hands. You just need to simply sign into your student portal, and the tax slip should be available to you by the end of January. Usually that's pretty close. If you don't see them posted on your account by the end of January, give the institution a call, yell at them, and get them on their date, and hopefully by the middle of February, you should not wait any longer for those. Interest on student loans, again, same thing. We pay back our student loans, we pay a little bit of interest on those. We get to write the interest portion off, not the actual payment of our student loans. And the government will send you a slip, usually in January or February, and if you don't have it, again, start harassing student loans. They do have to give it to you, but sometimes they take their sweet time, and lots of times I don't think they actually issue them. So, something to keep in mind. Fun one, volunteer firefighters, marine search and rescue, all of those other fun things, okay? We have a lot of people that will do volunteer basis employment on the side of their regular job, or for our wonderful service providers in our cities that actually do it full time. There is a little bit of extra tax credit for being in that profession. It's after 200 hours of service, okay? If you have put in 200 hours of service in a firefighter or rescue capacity, you need a letter from your employer that dictates that you are allowed to claim the extra service credit, okay? This is one that does get audited as well. So it's important that we get that documentation so we don't leave ourselves hanging and ready for an audit without being prepared, okay? Adoption expenses. If you're one of those families that chooses to help the adoption world and take on a new family member, you can actually write off a good portion of most of the actual adoption fees, legal fees, things like that. So that's always something nice to keep in mind. And if we are first-time home buyers, we get to have a $750 credit added to our tax refund. That is actually the dollar value, okay? It is a $5,000 tax credit, but it does physically add $750 to our tax refund. Do I qualify for the home buyers plan? The home buyers, like the home buyers amount, basically says that you have not purchased a personal residence before. This will become to couples and things like that. If both people's names are on the documents, you can apply it to one person or the other, not both. And if one person has used it previously and the other hasn't, they qualify for it, okay? Things you need to keep in mind when you are going after the home buyer's amount is you need to be able to produce the purchase documents that have your legal name on them and the date that prove that you actually did purchase that house in a given year. Yes, this one will be asked for. Again, this is one of those after tax season audits that usually come in about July or August. It's a big tax credit, so it does unfortunately serve itself well to extra audits, which is not so much fun. A couple more deductions we want to talk about is medical expenses. We all have medical expenses. Some of us have private healthcare plans, some of us don't. Some of us have work plans, some of us don't. If we are one of those people that falls into an employee health benefit program, if your employer does your taxes a certain way, you could have an amount on your T4 for medical expenses as far as premiums paid towards your healthcare plan. That's great. You don't claim those amounts again. That automatically gets added to your medical schedule when we take it off the T4. But if you have private healthcare plans, so you have Albertan Cross, you have Manulife, you have Sun Life, you have any of those things that you pay into individually, your premiums are a write-off to you. And this is not something that people talk about often enough, but it's very, very important because unfortunately they do like to jack the rates up on those, that if you got a whole, gosh darn family or a whole litter of people using it, it adds up. So you do get to write off your private healthcare premiums. You will receive a statement. The best one for statements is actually Alberta Blue Cross. They do get a bad rep with people in Alberta because they do have their moments with pricing, but they are the first people to send out your statement, and it'll actually say premiums paid to healthcare plan. So that's the total value that you need to bring to us, the tax preparers, so we can put it on your tax return. Over and above that, you can claim any non-reimbursed expenses. So even if you are part of an employee plan, anything, the portion that's not claimed or not reimbursed by your healthcare plan, you can write off. So if you got a big set of dental work done and they reimbursed you for 80% of it, the other 20% goes on your taxes as medical expenses. So you don't get to just have to put out those dollar for dollar values out of your pocket and get no credit for them. The government says, thanks for using our healthcare system. Let's give you a little bit of a thank you. It's not a hell of a lot, but it does add up. Medical expenses, the one I want added here that's not included here, and I do apologize, I normally do add it, is celiac or special dietary restrictions. Okay, this is one that's come up and unfortunately it has kind of flipped itself into a bit of a fad over the last couple of years. When it comes to medical expenses, I myself am celiac. I choose not to write off any extra dietary expenses on my tax return, and the reason why is because you don't just get to go and spend all the money on extra dietary restriction items and write the dollar value off of all those groceries on your tax return. That's not the way it works. What you have to do to say, we'll just use celiac specifically, if I have to buy the alternatives and they're more expensive, what the government requires from me is that I do the calculation between the gluten or the celiac friendly product versus the normal price product, and you only get to claim the difference between the two. If you're like me, that sounds like a hell of a lot of work for pretty much no gain, okay? It's not just, please go spend all this extra money and write it off of your taxes. It just doesn't work that way. So a lot of people will opt out of it because it's just a little bit too much. Okay, but if you want to do that, by all means, just keep a spreadsheet and you need to be able to produce the receipts. So be prepared for that. And last one about medical expenses, which is great, you decide that you want to travel to get your medical expenses done. If you live in Edmonton and you got to drive to Calgary to go see a specialist, awesome. If you keep track of your fuel expenses, a rough kilometer log if possible, if you're going to be physically driving towards places, it's great, as well as any receipts. So if you have parking, if you have accommodations, if you fly, you can write off those expenses. Now, when we talk about travel, we talk about big things like going to Mexico and getting a gastro bypass surgery. Awesome, you can do that. The government is not necessarily going to allow you to write that fee off on your taxes, okay? When it comes to big procedures done in other countries, if you want to go ahead and try and claim those on your taxes, there is a schedule that allows you to claim out-of-country medical expenses, but they have to be like medically necessary procedures. So if you are not on a waiting list for an organ donor, you don't qualify to write off your out-of-country medical expenses because you flew to Mexico and got a kidney transplant. Okay, they don't consider it medically severe, so it's an optional procedure. Okay, that sucks for a lot of people, and it's something that again people don't talk about. But let's be realistic when it comes to what we can and cannot claim. Okay, so if you have a letter from your doctor that says it is medically necessary for my client to kind of jump the queue system, it's going to take a lot longer by North American standpoint, and he needs to go fly to Mexico to get this surgery done. Awesome. Keep your documentation, your flights, your accommodations, any extra costs, as well as the cost of the actual procedure, and you can submit them to CRA. Okay? The turnaround time on it is lengthy. They usually take about a year to process those, so you can claim them. The refund will be there if that's what the case is, but it will go through the audit process, and it will just take time. Okay? So you can claim out-of-country medical expenses. So we basically talked about donations are great. Please keep donations for tax returns. It's a scaling credit, so the more you claim over $200, the more taxable benefit you get. Okay, and again, it's not 100% dollar for value. It's 15% of the total. Now, red flags. We have talked about some of these already. Moving expenses, union dues, medical expenses. Medical expenses. The thing that predisposes you to an audit is more than $2,000 in a given year, give or take. Okay, so if you were claiming a big orthodontic procedure for your kid and it costs $4,000 and you have to pay out of pocket for it, be prepared to have it audited. It's just the way it works. So get all the documentation you need for it, so that it makes it really simple. Union dues we talked about. Eligible dependents, new parents. We have a kid. We're a single parent. We want to start claiming an eligible dependent. Awesome. That is your right to do that. That is a heavy tax credit, and it does influence our taxable income quite heavily. We need to be prepared to produce a birth certificate that has our name on it, court documents, co-custody agreement documents, or a letter from the other partner saying that this child lives with me full-time, I'm responsible for them, and I get to claim the eligible dependent. They do get audited quite often, and it is important that we do make sure that we have the documentation in place, again, to make it a little bit simpler. Filing back taxes. Same thing we talked about before, is if you go back, you can get back payment for things like eligible dependents, for disability amounts. Those can be audited. They're just at a slightly higher likelihood. So if you're going to go back and you know you can claim your kid on your taxes and nobody ever told you, you want to go back 5 years and do it, that's awesome. There might be child tax benefit there for you. There may be additional tax refunds there for you. Be prepared for the audit. It's just going to come to validate that they're actually supposed to pay you those large amounts of money, which means same thing as above. You need to have the birth certificates, you need to have the custody documents, and any other stuff that you can put together to basically make your life easier. Now, we have about 15 minutes left, so I'm going to kind of go through. We talked about some of the stuff on this next page already. Let's talk about marital status. When we are common law or married, we need to be claiming our significant others on our tax returns. Okay, this is a point of contention for a lot of people, and they say, well, I don't really want to claim it because there's this huge, it's this huge mystery around claiming together. It's both. Okay, it doesn't hurt you to claim the other person. Okay. The only time it's a significant detriment to us if we go from being a single parent with an eligible dependent to being in a common law or married position, we lose our eligible dependent. Okay? We can't claim those tax credits because we now have somebody else in the picture. Our household income has risen. We don't get that tax credit anymore. But other than that, the little piddly amount for GST you get every year, which is like a whole maximum $400, yes, that will disappear when you claim together. But it's not going to be the end of the world, so stop stressing about it. Additional point that I need to throw in here is if you have a baby and you are with someone and you decide to claim common law after a baby is born, you're going to be audited because they consider the 9-month period when you are pregnant a possibility of actually the time when you should be claiming common law. Now you say we actually legitimately did not live together until baby was born. Awesome. Be prepared to include utility bills, addresses, documentation to prove that you didn't actually live together. Otherwise, it'll get denied. Child tax benefit gets clawed back, all kinds of ugly ramifications, and it's just a problem. Okay, so if you're having a baby, you're with somebody else, claim together on your taxes. It's just easier. It's not worth the struggle. If you're filing separate but together, so you're filing your tax return with this person and I'm filing my tax return with this person, you need to be able to produce the other person's tax return if possible, or their SIN number, their full legal name, their full date of birth, all of that fun stuff, plus their taxable net income. So that bottom line taxable income that they have on their tax return, so that they can calculate household expenses. So things like child tax benefit, GST, etc. Okay. We talked about home buyers plan, transfers that can come in. Again, we can transfer disability if I have no income but I qualify for the disability tax credit, but my significant other works. They're going to take advantage of the disability tax credit to lower our household income, which means we increase our household refund. But me as the individual with it, because I have no taxable income, means I can't use it. Okay? Pension splitting we talked about. Age amount. If you are an elderly couple, there is an age amount that can be transferred to the other person as well. Tuition, we can transfer up to $5,000 per year to one parent or grandparent or one other person like our spouse per year, and that's the maximum, okay? 5,000 federal, 5,000. So we do have that available to us. I'm not going to go through all the student stuff. I'll let you guys read that. If anybody's students in here or has questions, just give us a question after we get to the end of it, as well as there's some information on textbooks and education amounts. Big one is that you don't need to keep all those individual receipts for all your textbooks. It just doesn't work like that anymore. It's all down to a flat rate system based on how many months you're in school, full-time and part-time, and they do the calculation for you. So as soon as we get that T2202, which is our tuition form, it actually does all the calculations for us, and we get a little bit of credit there. Those amounts do factor into our carrying tuition amounts that can be used from year to year. Make sense? Yes? Okay, wonderful. So that's the big information. The last one that I'm going to talk about a little bit, I'm going to skip back to another page because we kind of went over it quickly, is the difference between what we can do to increase our refund. Okay, so people come to me, and I'm going to end with this, and we'll just talk about this a little bit here, and I will open it up for questions, and this is the one that always has questions. Okay, so when we talk about, you come into my office and you say, Danielle, my friends make the same amount of money as me, and they get an $8,000 refund, and I get nothing. What am I doing wrong? I don't understand. Well, number one, what's going on with your friend is probably not that black and white, which means you don't understand everything that's going into their tax return. But say they're exactly the same situation as you, and you go, what am I missing? In my opinion, you're missing using your hobby or side hustle to increase your tax refund. This is a core principle of my business, and basically what I spend a good chunk of my time teaching people to do. Okay? So when you're sitting in position and you're like, I'm barely riding the line, I'm not really getting much refund, and I want to know what the hell I can do different. Well, let's talk about the buzzwords that is RRSPs, which is what normal people's reaction is. They're like, well, if I want to increase my refund, I'm going to throw all my money in RRSPs. RRSPs are a great tool. They're awesome. They do help us down the road. I'm a financial advisor as well. I do absolutely see the merits behind RRSPs, but they are not, in my opinion, as a tax preparer, the best choice for your money. Okay? If you want to use them, you have taxable benefits through work, all that other fun stuff, absolutely use them. But they are the highest tax retirement vehicle. They are 100% taxable when you put them in and when you take them out, which makes them not actually that cost effective to us as the individuals. They are a temporary tax break. In my opinion, they should be used as a last case resort. If you have money that you want to put away for yourself, utilize your tax-free savings account and use the second option we're going to talk about, like I said, which is capitalizing on a hobby before we put our money in RRSPs. Okay? Rematching through work, like I said, free money, absolutely take it. I'm never ever going to stop on that. That's awesome. Okay? Deadline, coming up with extra money. Again, we talked about March 1st being that deadline that we want to adhere to if we are going to use RRSPs on our tax return, which is great. Let's talk about the smart way. Okay? Every single person out there is going to spend money on their home, their vehicle, their cell phone, and usually something that they're passionate about. Okay? How do we take something that we're passionate about and make it work on our taxes? Well, the beautiful law reads that we do not have to have income, we have to have the intent to make income. A lot of people will start a side business or they'll do something that they love and they go, I'm scared to claim it on my taxes because I didn't make any money. Or I feel like the income that I did earn is not high enough to be taken seriously to be claimed on my taxes. Number one, I want you to get both of those phrases out of your mind because they are total and complete bullshit. I'm going to let that sink in. Yes, I said bullshit. It's okay. Okay, they are. The reasons why we've been told that is because, again, the government doesn't want us to use our own money to get a bigger tax refund. That would be ludicrous. So let's talk about what we're passionate about. Maybe you're a hobby photographer. Maybe you're a graphics designer. Maybe you are a woodworker. Maybe you are a plumber. Maybe you are a mechanic. And and you decide that that's something that you actually do love that counteracts what you do as a 9 to 5. I run a tax business 9 to 5. I love my job. But my side hustle is a photography company. I'm a hobby photographer. I love what I do, and I'm smart enough to know that I'm going to spend that money regardless of whether I claim it on my taxes or not. So I might as well get my butt in gear, get it on my taxes, and get a little bit of extra credit on my refund. So what do we need to do there? We want to create a loss using everyday expenses. Like I said, home, auto, cell phone, all of those things, okay? So we don't need to have earned income, we have to have the intent to earn income. Now this is not a blanket statement set up to have you abuse the system, which means I invest all my money into something that's never possibly going to earn me any money. Woo-hoo, let's pay $10,000 a year. Not the smart way to do it, okay? We want to talk about actual hobby businesses. A loss created from a hobby business or a side hustle is a dollar for dollar reduction of your taxable income, the same as RSPs, okay? RSPs, like we talked about, if you put in $5,000 worth of RSP money, you're only going to actually realize a third of that value in relation to your bottom line tax refund, okay? A third. Whereas you're taking 100% totals of everyday expenses when you run them through your side hustle to reduce your taxable income, which increases your tax refund, okay? This is one we're going to follow up with. There will be some questions about that, and that's totally fine. The very back page of your handout is everything that you can claim on your sole proprietorship or your side hustle, and this is the part where questions start to come through. We don't have enough time to go through all of this today, and today's purpose is not to just go through the business side of things. Every once in a while we do a business mastermind, and we will do another one in May, so if you have a hell of a lot more questions about having a small business, either book an appointment with me, give me a shout, send me an email, or attend one of those events, and we can dig into it a hell of a lot more. But if we go back to the last couple points on here, it is the easiest legal tax shelter that exists to Canadians, okay? And you're perfectly allowed to do it, okay? It's incredibly unused. People don't talk about it, people don't use it, and it's awesome, and it's something that you should, okay? You don't need a GST number when you're talking about any kind of side hustle that you do until you reach $30,000. That's something that's incredibly important. If you guys want a little bit more information on GST and setting up your sole proprietorship, I actually do have an educational video posted to our Facebook page, and it's on our website if you guys want to take a peek at it. And I do go through all the specifics on whether you need GST, what point your business needs a GST, and then moving your side hustle from a part-time gig to a full-time incorporated gig. Okay, so I'll leave those down here. That's the introduction to taxes. That's the vital pieces that I feel that you need in order to be a little bit more informed when it comes to your tax returns. And that's kind of the end of the follow through the handout part of the presentation. So the cliffhanger at the end of it, like I said, talking about small business, that's something that I always do delve more into. If you do have questions, feel free to ask about it, but it's something that is a really simple answer that addresses one of the big problems we hear all the time. What am I doing wrong, and what can we do better? So something to consider. Now, just because we're going to open this up to questions, both from anybody listening virtually and anybody in the room right now, I will follow that up by saying that we do flat rate personal taxes at $49.99 plus GST. Flat rate service means that you could have 47 slips. It's still going to cost you $49.99. We do that on purpose because I don't believe in nickel and diming my clients. You can go to other competitors and they will charge you things like $2 a slip, or if you add a rental property, they'll add another $100. You add a things like that. They will add all those fees. For me, if you have a rental property, it is $69.99. So we add a little bit, but only $20 in order to do the rental schedule. And if you're a sole proprietorship, we do it for $125.99 plus GST, which includes an hour of bookkeeping, sorting, and receipting, as well as your GST return. If you have a bigger, more comprehensive sole proprietorship, we charge $40 an hour in additional bookkeeping as needed. So that's my selfish plug. We are available and taking new clients in the new year. We will have 4 full-time tax preparers working in our office this year that are a walk and talk and invitation with me. Yes, I've grown this business. I am not the only tax preparer in this office just because my name is attached to the business. I was for a number of years, but we've moved past that place, and I'm incredibly thankful for all the clients that have helped us get there. So if you guys do need tax help, give us a shout. The phone number is on here as well as on our website. That's the easiest way to get a hold of us, or you can book through the administration email on here as well. So now let's open it up to questions. Yes?
How many side hustles can you have?
As many as you'd like.
Are
Now,
you serious?
the caveat with that is that you can't claim vital expenses more times than once. Okay, so if you have 4 side hustles, right, you can only claim your home expenses on the one that you earn the most income on, so any one. You can only claim your vehicle expenses on one, and you can only claim your cell phone, internet, and home phone on one. Okay, but your advertising, your supplies, your office expenses, your legal fees, your all the other extras that go into that business, you can claim each one individually, as many as that entails, as long as you, again, have the documentation. You'll notice on the last page of my cheat sheet here, this is my lovely Bible to you when it comes to having a side business. You gotta keep your receipts and documentation for everything, okay? It is easier for you to split them up by business if you do have multiple side hustles, only because when you get audited, it's easier to present CRA, you know, if you were to get audited. This is side hustle number 1, all of the expenses and income. This is side hustle number 2, all the income and expenses. This is side hustle 3, 4, 5, etc. But there's no restriction on the number you can have.
Do I need a name for every side hustle?
No. You don't need to go as far as actually trade naming your business. The only reason I suggest trade naming your business is because if you have a common name or you have something unique and you don't want anybody else to operate with the same name, to a point, because registries only enforces it so far. If you trade name a business, it costs about $25 at the registry office. It's not a bad thing, it means somebody else can take it, but you can just call yourself Joe Blow's Plumbing if you want, and it's perfectly fine too. Makes sense? Okay, is it about the same thing? Or is it
I forgot.
Okay, let's go over here.
Yes, I have 3 questions for you.
Okay.
1, should I file my tax return jointly with my husband?
Yes. Reason why is because it's easier to keep all the tax credits and all the preparation under one house. If there's any calculations to do with kids and things like that, it's easier. But like I said, if you want to file them separately, meaning he goes to one place and you go to another place, or I want to file mine right now, he's waiting for all these things, you can file them separately, but you need to be able to at least do an estimation of what the other person's income is going to be, so that you can make sure all those family tax credits, if they are in place, match out. Otherwise, both of you can be selected for a reassessment. If I claim that my husband's income is $40,000, he actually files his taxes at $60,000. Now we're both eligible for a reassessment because we didn't match those numbers up 100%. Whereas if we prepare both tax returns in our software, it amalgamates everything and pulls all the information from the other person's return, as well as it can allow us to move credits from one return to the other as necessary to make sure as a household we get you guys the biggest refund.
So if we do that online when we file tax. And last year we moved to Ontario to work for 6 months, and things didn't work out. That's when we moved back. So when we moved there, obviously the company paid for everything, the moving expenses. But when we moved back, because things didn't work out with the company, we moved back on our own cost. So we paid for everything, the kids, and so can we move that expenses when we move back here?
Did you move with an actual start date for a new job back here?
We did not have a job. My job was when we moved.
Then you can't claim those expenses. It can't be for the intent to find work. It has to be because you actually have a job offer.
But we have a house here. There we were renting a house. So we moved back because it was like we were paying $6,000 in dwelling every month, so it was not worth it. So we came back because we have a house here anyway. But we couldn't sell because of the market. So it's still, that's the main reason why we moved back. Else we would have resigned and looked for another job there. Do you know what I mean?
Yeah,
so it's still
you
making
can't claim
expenses.
No. It really sucks. Like, I kind of wish they wouldn't give people moving expenses at all because it's so hard, and they dangle this carrot and they say, oh yeah, if you move, you can write it off on your taxes. But the schedule, the way it actually works, we have to put in the previous date of your last employment, the start date of your new employment, the address and employer's name, as well as the distance between your previous house and your previous employer, your previous house and your new employer, as well as like all that other critical information. So if we don't have that information, the schedule number 1 doesn't even populate. I can force it to populate, but it's going to get audited, and unless you can produce that checklist of things that apply, they're going to deny it. And it's not worth the audit, and it sucks. It's actually, that is one of my biggest pet peeves with taxes, is moving expenses. And when I tell people how it actually works, nobody's very happy with me. So I don't like to be a bearer of bad news, but I'm a realist as well, and it's not worth the audit, and you won't qualify.
And my husband has diabetes, but so the doctor gave him like a special prescription for certain medication. So we have to pay from our own pocket because the insurance didn't cover it. So can we claim those?
Yes, those go on your regular medical expenses. Is his diabetes detrimental to his day-to-day life? Like, it's something that severely interferes with how he works and how he functions?
And he made that expense in 2017. So can we still claim it?
Yes, you can claim it in your 2018. Yeah.
As long as we get like
as long as we get a statement and a summary of those expenses. Yeah.
Okay, I remember.
Okay.
How many years can one claim a loss on a side hustle?
I hate that question. There's no definite answer to that. Basically, what we want to do is avoid milking the system.
Yeah.
So if we're not actually really starting to run that business, we should try not to run a loss over a number of years.
Yeah.
I usually recommend that, even if you made $100 doing your side hustle, that's income earned, right? Anytime that there's income earned, even if there's a loss, it looks better. Like, you don't want to claim a loss in continuing years without any income.
Yeah.
You can run a loss for the rest of your life in a business, because there are some businesses that just require you to put in more than you're ever going to earn, unless you decide to switch permanently from a part-time to a full-time business. Take, for instance, say a multi-level marketing business like, I don't even know if they're still around anymore, but let's just Sensi, okay, because I used to run Sensi. So you have to buy all the stock beforehand, right? And then you have to hope that you can pass it along to customers and sell it. But you're always reinvesting your money back into that product, and you may have products sitting there all the time, right? And there's 100 businesses that all have that same model, right? Well, it's okay to continuously claim a loss, because you might sell 3 or 4 or 5 a year, even if you only sold 1. You have the intent to make income, you're earning income, and you're basically at that point writing off your stock, maybe a portion of your vehicle and your cell phone. So it's not huge, and it's not like you're sitting there just actively milking the system. The rule of thumb is that if you're not earning any income at all, we want to, stay away from claiming a loss year after year. But as long as we're trying to run our business and we have the intent to make income, it's not the end of the world to claim a loss year after year after year after year.
Is there any percentage that you just take it, how much percentage that you can claim?
Say that again, sorry.
Is there any percentage that you can say that you would as loss, like income versus that sense?
I'm gonna say usually when you go above the $2,000 to $5,000 mark, like say $5,000, right? If you claim more than a $5,000 loss, you can always do it. Just be prepared to be a little bit higher eligibility for an audit, right? Now, if your income is $200,000 and you claim $5,000, well, you're probably not going to get audited, right? But if it's you earn $40,000 a year and you spend $5,000, it may be more eligible for an audit. The rule of thumb, though, is above $10,000 in losses, you will be audited. Again, some people be the exception to that rule, so I don't want to put in my mouth that it's 100% all the time. But when it comes to losses on our sole proprietorship, our side hustles, things like that, we want to act like we will get audited. If we act like we will get audited, we're always going to make sure we keep everything accountable. We're prepared for it. And if it doesn't happen, awesome. If it does happen, we go, well, this is a giant pain in the butt, but it's not the end of the world, and it's not screwing us over because we're not prepared for it. So if you were to have a conversation with CRA about what you're doing, do you think they'd say, that makes sense? Or they'd go, oh, it's so cute. No. That's the determining factor I use. And it's just not black and white. So, as much as possible, we try to do those percentages, but yeah, don't go above a $10,000 loss if you're not earning at least a couple $1,000. And if you legitimately are, just keep all the documentation. That's all.
Is there a penalty if you don't claim common law? That you can get together for.
It's not a penalty, but they'll go back and they'll reassess it. And I will say this, if you do a reassessment on a family scale, so if you have kids and things like that, and your audit and reassessment goes back through the child tax benefit desk, your life's going to be living hell. They're just not very nice about going back and doing reassessments. They will claw back child tax benefits. They will do things like that. They can eat Alberta climate change rebates. They can, eat GST rebates and things like that to pay those debts back. That's where it's a really big problem. I'm also just never going to say I'm an advocate for not claiming together if you've been living together for more than 12 consecutive months. And that is not applying to calendar year. That is applying to consecutive 12 months in a row. Okay? Now, it's actually in your worksheet, and I didn't go through it specifically, but I will now, is if you separate from somebody, that's the other side of it, right? We've been in a relationship for a long time, and we decide that we're done being in a relationship, and we want to split our ways. We've already been living together, then what we need to do is keep in mind 9 months. Okay, CRA will not go back and actually recognize separation for 9 months, which means we need to have change of addresses for 9 months. We need to have separate living, like totally separate residences for 9 months before they will be eligible to go back and do any reassessments. Meaning if mom goes from being married to being a single mom, or dad goes from being married to being a single dad, we want those child tax benefit calculations to be revisited. They will not revisit those for 9 months. That's just the reality of it, because we could do the on again, off again teenage mode of dating, which means 3 months we're together, 3 months we're not, 3 months we're together, a day we're not. They don't recognize any of those kinds of things because, can you imagine how much work that would be? So you need to be apart for 9 physical months with different addresses. And I've heard it so many times where somebody's like, well, my husband couldn't find a place, or my wife couldn't find a place, so they lived in my basement. I'm going to tell you that, yeah, you can argue with CRA, but it's really difficult if you cohabitate after you split up and you still try and claim separated and get those benefits and credits recalculated. They just don't like it. So, as much as possible, try and keep the documentation as clear as possible. So when we do split up, separate addresses as soon as possible. And then if we're claiming together, I'm a big advocate for being honest, because at the end of the day, if you do get caught, they're going to look at it more harshly. They're going to go back and reassess you, and then you can be considered kind of a pre-screened person going forward, meaning, well, you lied to them once, so they may consider that you would do it again in the future. Does that make sense?
I have a question. So selling principal residence, if the taxpayer fail to disclose, is there any responsible for tax preparer for the penalty, or it is the responsible for the tax?
It is the responsibility of the person. This is something that people haven't always told people, right? Like, this is, like, when we do taxes in our office, we ask you if you've changed residence in the last year, right? We try and catch that with everybody. If there are cases where somebody didn't tell you that that was something that you needed to do and you didn't disclose it, and you realize that now, and you haven't been flagged, my best advice for you is to get the printed schedule, so come see a tax preparer, get the information, fill out the schedule, get them to file an adjustment and send it in. Most of the time they won't issue a penalty in that regard, but it's always better to say, hey, I screwed up because I didn't know, and I'm trying to actively fix the problem. There likely won't be an interest and penalty applied to you if that's the case, but if you're actively, again, just try to hide, you're trying to hide from the system, they're not going to look on it very nicely, and there's not really a lot of forgiveness when it comes to the interest and penalties on that guy.
If the husband buy the house first time, then wife name is not the title. So wife bought house the second year. So both can claim the first time house owner, or the
But they would have to do it year after year. So in the same year, two people can't claim the same credit.
right.
So if one of you is going to buy one and the next one's going to buy it, and this is disclosure about house flipping, and I'm just saying kind of how it is, okay? If you guys decide that you want to buy multiple properties and you want to do it in each spouse's name, just stagger it from year to year, and then you won't be able to claim the home buyer's amount again going forward.
So if the house and both like partners name on the titles,